Hey guys, PK here. In this episode, we'll be talking about an investment opportunity that often, gets new investors really excited. They think they're onto something. They often find an ad on Facebook about these types of things. And really, it's a slippery slope to what can be some pretty significant disappointment. Okay, so in this episode, we'll be talking about NDIS, the National Disability Insurance Scheme, what it is, the benefits, the pros, the cons. Okay, and as I go through, even if you're not interested in NDIS, I'll be weaving through, as I go through the pros and cons, I'll be weaving through just really fundamentally strong, sound investment principles, why NDIS doesn't make the grade for me, and even if you're not considering NDIS, how these principles will aid or should or could aid your own investment thesis and how to grow wealth, how to build passive income, how to build, a retirement through property investment. Okay, so stick around till the end. And I just want to say as well that I'm really, really grateful. I don't think I've said it enough, but I'm really, really grateful to each and every one of you who, are part of this community. You take the time out of your day, out of your week to watch these episodes, to listen to humble old me. I'm so grateful that we can have a dialogue in this way. I know it's me, the person who's speaking, but I genuinely get so much reciprocation every time you share, every time you leave a review, every time you message me on Facebook. There's so many ways that so many of you reach out to me and say thank you or give me suggestions to improve. I'm just so grateful to each and every one of you for building this tremendous, just really honest community. All right, let's bring back the honesty in property. That's kind of my mantra these days. All right, let's go to NDIS. So I know that, and especially on Facebook forums and other forums, every 2 weeks there's sort of someone who pops up and says, oh, guys, I've found out about NDIS, great investment option based on what this company is telling me. What do you think? And, the wise old heads in the forums and the communities kind of give a knowing look to each other and kind of disregard it for the most instances. But really, I want to break it down and give you a more informed view of why NDIS, maybe for some people 1% of investors, but probably isn't for you, just like it's not for me. So let's start off with the benefits. So why are we considering NDIS in the first place? The hook, the bait that gets us drawn towards NDIS is higher yield. So what this is, right, is the government is incentivizing property investors to invest in these special types of properties where those who need it, people with disabilities, can reside. Right, obviously, and the rent will be paid to a large extent by the government. Okay, so from a social perspective, it's a really, really good thing. I think that there needs to be more of it. I think the government needs to do more for these types of folks, but also just build more houses, all right? Because there's a chronic undersupply of rental houses. So that's kind of the theory, the principle behind it, very good thing for them to do. And from an investment perspective, it makes a ton of sense, you could say, from one angle of vision, because the government is willing to give very high yields. Right? So they're able to give, or they say they can give, between, let's say, 6 and 16%. I'm just using generalization here, sometimes a little bit, in the middle, but let's say 6 to 16% gross yield, which on the face of it is pretty good, right? Because if you invest in a capital city these days, you're not beating 5% yield. And if you're investing in regional areas, which, by the way, are no inferior than capital cities if you follow the data, but you're getting maybe 5 or 6, maybe 7%. So on the face of it, this NDIS properties gives you so much extra yield. And you can also say that this yield or this rent is backed by the government. So how could you go wrong, right? How could you go wrong? I mean, cash flow is king, right? Passive income. Let's take it home. All right. So those are the pros. But now let's excavate the cons. Let's really, dig deep and understand the other side of the coin. So the first con is that a lot of banks won't actually lend to NDIS properties, to NDIS builds, right? And the reason is it's specialized property, right? So banks are very conservative. They don't really like to lend to, unique types of situations, even Airbnbs, right? Like even if your Airbnb property went up, the banks don't really allow you to refinance as much as they would for a normal residential property. What to speak of NDIS, where it's a very specific type of property, made to order almost, or made custom build for the needs of the disabled person or disabled people, right? So it's very unique, it's very specialized, and banks don't like that because it's not evergreen, all right? It doesn't have marketability to a large audience or to a large populace. So that's the first thing. Don't expect banks to be your friend. The second thing, the second downside or con in NDIS property is higher interest rates. Now, with that same point where banks don't favor it, they're going to slap it with a risk premium. So you might be paying another 2% interest rate on your loan on this type of property. And right now, interest rates are very low. We all know that they're going to increase at some point in the next 2-3 years. We just don't want this artificial penalty of higher interest rates because of the type of property we bought. We don't want to make life more difficult for ourselves as investors. All right, so that's the second downside. The third downside, once again, to do with banks, is that you generally need to have about 40% deposit to build or to get this loan to build an NDIS property. Okay, let me kind of qualify that. So there's one part of it is banks aren't going to let you borrow at 80 or 90% LVR or 80 or 90% loan to value ratio for these types of properties because they deem them as higher risk. But the other thing is with an NDIS property, right, what you're doing is you're building it, all right? You're building it because it's custom designed for the needs of these particular types of disabled people, all right? And so when you build it, oftentimes the value that you think that house will be, it doesn't end up being that, right? Because by nature, you've had to overcapitalize, putting all these special types of bathrooms, bedrooms, this and that, right? So these properties just don't value up. It's not like an NDIS property where 3 bedrooms is worth the same as another residential property down the road with 3 bedrooms, right? And so what you need to be prepared for is the bank saying, look, yeah, I knew, or I know you think that property is worth 500K. We actually think it's only worth 450K. We're still going to give you the same amount of loan. So if you want to follow through with this purchase, you're going to have to stump up more deposit. All right, so that's another downside. That's why I'm saying you need about 40% deposit, which is a lot, And I said at the start of this episode that we'll be talking about general principles as well. In property investment, you want to build, ideally, a property portfolio quickly, right? And you build it quickly by putting as low deposit on for each property as possible, right? You keep it positive cash flow, you put as minimal deposit as possible, and that way you preserve your own capital, your own cash for subsequent deposits, right? Now, if you're putting 40-50% deposit on for a property, like that's a lot of money. You're probably not going to be able to buy another property for another 2, 3, 4, 5 years. All right, so that's counterproductive to building a portfolio. All right, I think we're up to number 4. The number 4 downside of NDIS properties is management fees are higher. Okay, so at the start of this episode, I mentioned that The upside, or basically the only upside of NDIS properties, is that the yield is higher. In other words, the rent is high. Let's call it 6 to 16%. Let's just say 12%, because I think most of them average around there. So 12% gross yield is great, but that's only gross yield, right? Management fees, there's normally a company that manages your NDIS property for you. They take care of the maintenance, they take care of finding tenants, they take care of all the paperwork, all the legislation which allows the government to be involved and back the rent and pay you. There's a lot of bureaucracy, a lot of paperwork to be done. The company handles that. Now, they charge a lot of money, I must say, to do all of that. So whereas a normal property manager for a normal residential property, would charge, let's say, somewhere between 6 and 9%, I'm just using averages here. A property manager for an NDIS company, because it's so specialized and the work they have to do is so detailed and deep, they often charge 10 to 15 to 20%. All right. And once again, I just want to say these are generalizations. Not all companies are like that. But try to understand, if you're making 12% gross yield and you're paying 10 to 15% management fees, like that gross yield on a net basis is diluted significantly. All right. Is diluted significantly, which, after all these other things that I'm going to talk about in a second, means that net yield from an NDIS property, which is really the only benefit of having an NDIS property, is basically not too much different from a normal investment property, residential investment property. Okay, so management fees, that was the fifth downside. The sixth downside of NDIS properties is that the build cost is higher. All right, I touched on this a little bit before. If you're building a 3-bedroom, 2-bathroom residential property, let's say on one side of the street, a normal one, and on the other side of the street, you're building 3-bedroom, 2-bathroom NDIS property, because you're building it, or you're having to build it for the needs of the disabled people or persons. They need a particular amenity within bedrooms, bathrooms, kitchens, which naturally increases the cost of the house. So what you're doing is that you're spending, let's say, another 10, 20, 30% on build. I'm just using average numbers here, generalization here. Let's say another 10, 20% on build cost. What that is termed as is overcapitalization. All right, your capital growth on that property, if it's on the same street as a normal property, is going to be the same, right? It's on the same street, location, location, location. But that capital growth is coming off a higher base. You spent more money on this NDIS property, so therefore the return on investment is less. All right. Let's say you built a 3-bedroom house, normal house, not NDIS, 300 grand. It goes up 10% every year. Just use round numbers. Whereas on the other side of the street, you build an NDIS property for 400 grand. That goes up 10% per annum. That 10% per annum is not occurring on 400,000, it's occurring on $300,000, because you've overcapitalized by $100,000. So you're not getting the return on investment on that $100,000. It's like wasted money from an investment perspective. So that's the other thing. You're overcapitalizing. The seventh downside on NDIS properties is that the capital growth, notwithstanding the example that I just gave, is actually historically not too crash hot. Okay, and the reason is that these properties are more often than not more in demand in areas that are far outside of cities. All right, for example, in the Brisbane context, a lot of these properties are in demand out past Caboolture. Now, even Caboolture in these boom times has gone up, but fundamentally, it's not the best suburb for long-term growth. But this is where many of the demand sits for these types of properties. So you're investing, you're overcapitalizing, you're investing a lot of money in this area, which from a capital growth perspective is going to underperform other locations. And remember, in property investment, location, location, location. I know it's kind of a you know, this is the most cliched thing in real estate, but it's so true. The suburb in which you buy does 80% of the lifting in terms of capital growth. And so the problem is the demand from the disabled community for these types of properties isn't often in the better suburbs. When I say better, I'm not saying from a socio-demographic perspective. I'm saying from a data perspective, from an investment thesis perspective, from a location growth suburb perspective. All right, so that's the next downside. I think we're up to number 8. Number 8, downside of NDIS properties, maintenance costs are higher. Look, and once again, I don't mean to make any statements about the social conscience of anyone, but a normal, quote unquote, let's say a normal tenant, they're going to take care of your property because they've given a bond, right? They've given a bond. A bond isn't a secret handshake, but they've literally given you money, $2,000, $3,000, where if they trash the place, they accidentally knock things over, put a hole in the wall, whatever the case may be, you don't have to give them that bond back. You can take that bond and use it to fix the house. There's so many things that, like a contract you have with them. Whereas with NDIS properties, the people who live in the properties, they have no relationship with you because the relationship is through the government, right? Through the NDIS scheme. So they can often, I'm not saying they do, by the way, but there are anecdotal evidence, lots of it, that they don't treat the place as nicely as they could, and because there's no repercussion for them, or maybe they don't have an ability to do so. So what that means for us as investors is higher maintenance costs, and we can't recoup that cost from a bond or anything like that. It's just higher maintenance cost. All right, so that's like number 8, I think, where we're up to. Number 9, tenant vacancy can be higher. Let's look at a normal investment property. I have a tenant there. The tenant moves out tomorrow, put it for rent. Within a few days, I get a new tenant, done. With an NDIS property, because your clientele or your potential tenants are so specialized, right? Because by nature or by definition, they need to fit the criteria of having certain type of disability. And by the way, I think only less than 25% of people with a disability actually, fall under or fit the criteria of being eligible for NDIS scheme inclusion. Because they're so specialized, you might be waiting 2 months, 3 months, 4 months, 5 months. I don't know what it is, but I'm just painting a scenario here for your new tenant. So if one person moves out, you might be having a vacant property for a long, long time. All right, that's almost like a commercial investing without the upside. All right, so that's just a really deal breaker in my mind. I think we're up to number 9 or number 10, funding. So right now, like I said before, despite everything I've said, from an investment perspective, it's a social problem. Australians, people in this nation, in this country, in our cities, in our towns, who are disabled, need to and deserve to have a place to live, right? No one can argue against that. But the problem is that the government can flip-flop. Right now, the government is saying, yes, 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 we'll back this NDIS scheme, throwing millions, if not billions of dollars towards it. What happens when the federal election happens and policies change? Or what happens in 2 years, 3 years, 4 years, 5 years, budget repair, all of this thing? The funding can be taken out of the scheme whenever from the government. There's no guarantees. And then you're left with a property that's very specialized towards a specialized cause, a very niche type of tenant, but that tenant can't pay because the government is no longer backing their rent. Okay, so that is structurally or fundamentally a long-term crack in the strategy of investing in NDIS properties, in my humble opinion. Number 11, it's hard to exit. Okay, so let's say you bought an NDIS property. And by the way, this is just a general principle as well. Whenever you invest in a property, you should always have an exit strategy, not only for a particular property, but for the entire portfolio as well. and I've done so many episodes and videos on this before, but with an NDIS property, let's say you invest in it, everything goes well for a year or two, your circumstances change, you lose your job, or interest rates go up so much and you hadn't buffered in cash buffers, or divorce, things happen, life happens, and you need to sell. Who's going to buy an NDIS type of property? It's very, uniquely built property. From the outside, it may look normal, quote unquote, but from the inside, oversized bathrooms, and, it's made to make a disabled person or multiple disabled people's lives as simple, as easy as possible from a residential, perspective, from a living perspective. But that means that the house is completely, or to some extent, abnormal for a non-disabled person, and they could overlook it because it doesn't have the aesthetic appeal, the functional appeal as what they want. All right, so it can be very hard to sell these types of properties, and that's really the last thing we want as property investors. Of course, we don't buy property with the intent of having to sell it, but anything can happen. We should always plan for plan B, and this is just not a good investment strategy to buy NDIS, because plan B may turn into plan C, plan D very quick. And then the last, I think we're up to 12, 12th downside of NDIS is what you actually have to do is you have to, build. Okay, so the company who's your property manager often helps you develop it. You have to build the property. Then you have to wait 6 to 9 months for the government, NDIS, the scheme, to approve your property, to say, yep, it fits all the criteria, checks and balances for the type of property we want for these types of people to live in. You haven't taken any shortcuts, quality is good, it's meeting all our regulations and policies. That process takes 6 to 9 months oftentimes. What that means is for almost a year, you're without rent, right? And that's never a good idea. Like, who in their right mind would build something over-capitalizing, at that, and then just leave it there for government bureaucracy to give it a seal of approval? Like, in my mind, once again, that's not a good idea. And I know that these 12 downsides, they're generalizations. There's always exceptions to rules as well. And I know there's probably hundreds of NDIS specialized providers, companies you see on your Facebook, you see on YouTube ads, you'll see on forums, all this kind of thing. A lot of people of them may not be super happy with me because a lot of these 12 things are generalizations, but even if they are only half true, okay, even if they are only half true, it's just too much negativity, too many cons, too many downsides for me to be wanting to put my money there, or for me to be advising anyone, informally, of course, none of this is financial advice, to be putting your money there. I just think that, new investors, especially those of you who overanalyze, you'll come up with so many different tactics, strategies. I can invest in NRAS and seniors co-living and NDIS and defense housing, this and this and this. To be honest with you, taking my experience and so many other experienced investors, wisdom on board, there's no secret sauce. You're not kind of hacking the system, and you're not the only one who's found this amazing, scheme. If it's too good to be true, it generally is. Okay, just stick to the tried and tested, buying positive cash flow properties with high growth, established, try to buy it under market value with some value add potential. That's how I built my portfolio. That's how basically I would say the majority of people who have become millionaires in Australia through residential property investment, that's how they've done it, not through these fancy, fleeting strategies that come and go. So those were the 12 downsides. I gave an upside, which was higher rental yield, but I'll let you draw the conclusions about what is best. And I hope that even if you're not interested in NDIS, I hope that this commentary, this monologue, these insights that I shared were useful to take the principles, to take the logic and apply it in your own investment thesis. And an investment thesis is your own amalgamation of all the content you hear and how you synthesize it and what makes most sense for you. All right, that's what a thesis is. NDIS does not fit my investment thesis, and I don't have any bias as to whether it should or should not for you, but at least form your thesis based on what you've heard in the last 25 minutes. All right, guys, well, hopefully that was super useful. If it was, then I just really, really appreciate... Actually, I don't want you to do anything. I just want to say thank you. Thank you for watching. Thank you for listening always. Thank you for being with me. And I mean, these are just some great times to be investing in property. People think 2022 is too late to be investing. That's what they said last year. That's what they said 2 years ago. That's what they said 10 years ago. Get started now, guys, and I'll see you on the other side. Catch you later. Bye.